Hey guys, this is Leena with you. After a long time I'm doing this video. As you know, if you have checked out my channel, I do videos on insurance related stuff, primarily legacy planning, life insurance and health insurance side. If you have any requested topic, you can always tell me and I can bring the information for you. My whole idea is to bring awareness, because what you buy, you should always know what you're buying, not simply get into any policy which you really don't understand, or maybe somebody has just proposed you and you want to help them out. Please never do that. To help others, don't buy policies. To help yourself, buy your policies. So today what I'm doing is, today I'm sharing with you the very in demand topic, actually been requested for this video quite long time, and was just not getting enough time to bring you this video. Sorry for delay in bringing this video, but this is really informative video. Today we're going to talk about jumbo policies, also known as the premium finance policies. It is taking attention like a Bitcoin. It is taking attention like a Bitcoin from others, that what is these large policies are. It always start taking attention when your interest rates are really low, because you can borrow on the lower premium. At the same time, I would say the reason for that now in this market, in UAE market, of course there are a lot of international brokers practicing in this country with the private bank, independent brokers, independent advisors, and so you may hear from anybody who may not done it before, but they kind of bring you these policies suddenly and they say we are the guys for that. So you cannot judge whether these are the guys or how many policies actually they've done it on that, and also the skills of the sales guy, how they are, or relationship they carry with you. Whole idea to bring this video today to give you the whole kind of a immediate picture that how the mechanism work and what you should consider before getting into premium finance policy. What things you need to check. Maybe as I said, that somebody known closely, or you went to approach somebody to give you this policy because your friend purchased that one. Well, the policies are wonderful. It is, I would say, addressed to business owners primarily. They love these policies. Having said that, because they are not paying premium from their pocket, it's just they are leveraging their current portfolio. That's why these are so attractive policies to business owner. They're buying large and large and large. I personally know the person who has done the policies with me, like a $75 million by now. I have also shared my last policy, last one of my video where I mentioned about my $75 million policy. Why it takes attention? Because your friends are doing that, and it's just going to leave a large policy, large cash liquidity as a legacy to your family. Then what's the harm in that? It's like creating one more asset, by the way, liquid asset, into your balance sheet. You have everything on your place. You have business, properties, everything which is still market related, can go up and down. But jumbo policies are primarily, it's of course any life insurance policy is liquid. When I say liquid, you all gonna die, we all gonna die, you, me, all right. When we can be expensive to the company, to our own business, if we die too early. Even if you live longer, it's gonna be a problem too. So let's talk about die too early and why these policies are being so attractive. I think this video is for those who have already made the mind of going into it, just wanted to understand the mechanism, and few points which I want you to consider before signing up for these things. You should know the risk comes along with that. So as the benefit you might be just told, but you need to know the other parts as well before you make a final call onto jumbo policy, premium finance policy. What is it you need to know before that? So let's just see on my board. I just try to explain you in a simple manner that how it works actually. So there are three parties which is important in premium finance policies. It's no longer only one person insured. If you have been insuring yourself locally, here is life insurance is one person insured and you pay premium to insurance companies. So there are two parties involved. A person, let's say I'm insuring myself, I am an insurance company, that's all. But in this, there are more, because as I said that this is kind of considered one more asset, one more vertical in the whole portfolio. So there are more parties involved, like how you borrow premiums, borrow money from the bank for growing your business. Similarly here, you're borrowing money from bank to create one more vertical, liquid vertical in your business, in your personal life, by the way. So here we have important person, insurer, of course, you and the bank. These three parties are involved in the premium finance policy. So what is the role of these three parties? Let's look at that. So basically, insurance company offers you insurance, so covered you, so you are the individual person who is insured. I cannot insure a company. An insurance company cannot insure a company, so they have to have an individual insuring themselves. So you are the person whose life is insured against a larger amount. Let's put the number here. Let's say we are talking about $20 million policy. Put that number, let's say age 50. So I can give you example on that front. Okay. So insure, you are the insured person. And because these policies are one-time premium, when I say because we are using the bank to finance, so one-time premium, $20 million cover for age of 50. Let me use the hypothetical number, considering the person is in wonderful health, had no other health condition, and assuming one of the good product, we picked it up. So his premium, let's say, come into $6 million one time. So one-time premium $6 million, and that we are going to borrow from the bank. So insured person goes to the bank, and firstly, you're making sure that you are insuring yourself, you're in a good health, all the medical conditions are good. So we use the bank to pay your $6 million to insurance company. All right. How does it happen? Because bank actually lend money for these policies to a trust or a BVI company. So you need to create a BVI company or trust where your family member can be part of that. I think we can take the trust and BVI company topic sometime later. So let's look at the structure, focus on one thing at a time. So your bank, so let's say ABC Bank has given $6 million to your trust, which is your trust, let's say CBD Limited, that's your company, okay? So they've given money to CBD Limited, and CBD Limited is your company, okay? They are doing nothing else but owning these policies. So owner of the policy is this company, BVI company, or your trust, and insure is you. Okay, so you are insured under this. Of course, this is the owner. So bank is lending money to owner company, which is CBD Limited, and bank pays the premium on behalf of CBD to insurer. So these insurer are many. Most popular ones are Sun Life, Manulife, and they all have their plus and minuses, and that's, again, I'm not going into deeper onto the companies at the moment. So that's how policy has been on place. So bank paid on your behalf $6 million for a $20 million cover. Okay, simple. Now there are questions like $6 million has been given. What happens when the death happens for insured person? When this person dies, that time insurer will pay the proceedings to this company, BVI company, but keeping the bank in the loop, because bank has paid your premium. So the proceeding goes to bank here, which is $20 million gone there. So what bank does from there? Bank keep their $6 million because bank has lended you that money. Right? You borrow that money from the bank, so bank keeps the 6. Rest 14 goes to your company, BVI company, and that company, as I mentioned, you have your beneficiaries are already into it. So now is the job of that trust or BVI company how to distribute that fund. Most likely people have their family member part of their BVI company or their trust rules are already defined. So the beneficiary get immediate money, and because this money is offshore, no tax, no local law applies to any country, because this is international law, so there's no taxes there. So all money coming from offshore is for your family. if you have a business which may go into any kind of situation, because if you have a death and the business owner's death, then there could be many other liabilities coming from bankers or any other lenders. Those cannot touch this money. This money is only belongs to your beneficiaries here and sitting offshore. They can do anything with that money, right? And I said that no other people, no other lenders can touch that money. You may have local several liabilities. People do for the liabilities purpose as well. So it's on the beneficiaries how they utilize the money on right place. Okay. Now this is the basic structure. That's how the role of insurer, bank, and BVI and your is there. Now when you say 100% financing of this, I can explain that bit of piece as well. So bank is lending you this $6 million. Why would they lend you this money? Few reasons. Your profile has to be good enough. Let's say you are a multi-billionaire already, but that doesn't really attract banker to have you on the profile unless you bring something on the table for them. First policy is one assignment for them because policy is assigned, so they are secure. But what if a person cancels the policy tomorrow, or a year later, or 2 years later, or whatever? So what is the bank guarantee hold into that? So banks only also keep collateral on place that the person cancel the policy in a couple of years or tomorrow. What would they lose? Because the policy has a cash values as well. So let's say policy has a day one cash value which is 5 million only, day one cash value, day one CSV. So the difference is 1 million. So that means a person cancel the policy tomorrow, bank is still under 1 million loss, which they will never take that. Of course, no banks actually, the banks are very smart, right? They wouldn't do any business in any kind of a loss. So they ask you to keep 1 million collateral from the day one when they are giving you 6 million. So I'm giving you a hypothetical number, by the way. Many a time it is more than 1 million, of course. So day one cash value could be different, and how you want to utilize your 1 million lying there. Your 1 million is earning for you. You kept 1 million for that, and on the 5% you are getting $50,000 as your income. Okay. And here you borrow 6 million. So you need to, if you borrow any money from the bank, you need to pay, of course, interest for that, right? So currently, because interest is so low and it is not expected to go another 5-6 years easily so high, so it's still going to look like so attractive to people, business owners. LIBOR plus spread. So how somebody can negotiate, better negotiate. So LIBOR is considered as 0.15 and your spread is coming, let's say 0.60 or 50, whatever it is. Okay, put it in simple word. I want to go very simple for calculation purpose. Okay, so 50 is my spread, 25 is my LIBOR, so I'm paying 0.75% only, 0.75 and not even 1%. All right, of 6 million. So I'm actually paying around $50,000, and which is kind of knocking up for me here. So this and this get knocked off. So my charges of interest versus my income coming from $1 million goes knocked off. So I'm paying nothing from my pocket. I just kept this $1 million lying there, and I kept this money right up there, right? And this is my $1 million earning for me, and I'm serving the interest for $6 million. And the spread is like that. So what is the risk part of it? When you are getting into, you should know this very, very carefully. This is not fixed. LIBOR is the fluctuation part. It will be keep moving in the future as well. So you should be ready mentally when you are getting into such kind of a contract that you will be able to pay when the interest rates are way more than that as well. But still, even if it's like I've been monitoring these policies from past 10 years, and we have seen that interest rate gone really up as well. In between, the people were paying somewhere around 2.75 together this spread as well, but it was still kind of attractive to hold it. Unless your interest rate goes beyond 4%, then it will become complicated for you to hold such policies, because then you're paying way more from your pocket, and then you start thinking, but still it's way more cheaper than having a term insurance policy on place. Term insurance policy for a person of age 50 covering $20 million cover. Premium is no less than $300,000 a year, versus you're paying nothing from your pocket. Even if say the interest rate going up, you're still going to be paying 50, 60, 70, 80, 100, 150. Still 50% of term insurance cost. That's why these are so popular. These are why people like to go for these policies rather than going for term insurance policies when you're looking at high value life insurance covers. So there are many things actually which you need to kind of may have questions for, but I would say that I can also do some example video next time for you for exactly explaining the cash values. If you wish to, please do drop me a message that you want a detailed product demo, not a product demo, detailed demo, that how its cash value versus calculation will work and where this money goes, because 6 million is also not simply sitting with insurance company. They are using this money. All right, $6 million they receive, they are using this money to grow your policy, to make sure they are giving you cover for n number of years. Now here is the point. Here is the main important point coming in, which you need to know before you get into these policies. I told you like few things you need to know. You need to ask these questions to your advisor, whoever is proposing you these policies. Don't fall into any kind of scams. I personally come across several policies. They are so badly designed just to show lowest premium, so badly designed. I would say it's sometimes even shameful to see from big institutions those policies are being given to client, and clients simply think, oh, he's buying a beautiful jumbo insurance policy, he has a premium finance policy to flag around like to your friends that yeah, I have this policy, but you have such a bad policy inside that. So let's say once you decided that you need a car to commute, now you can commute with Tesla, Rolls-Royce, Toyota, Bentley, any car. So there is a difference between safety and guarantee of Rolls-Royce versus BMW, right, or versus Toyota. But you decided you're going to commute anyways, right? You need to commute from one location to another. You decided. So when you go to buy a car, you see, does it fit into my budget? Is it durable? Is it safe enough? So yeah, these things you need to look into your policy as well. So premium finance policies also have different type of mechanism, which I call it different engines inside that. These engines varies from Toyota type, BMW type, or a king of safety Rolls-Royce type as well. But because you don't know that what mechanism you are getting into it, you just think I'm getting into jumbo policy, but you don't know the mechanism inside that. So please do understand what product you are getting into it if it's a premium finance. So what you need to understand or ask these basic 3 questions. What is the minimum guarantee age into your policy? Minimum guarantee age in your policy, you should know that, because if a policy is index based or classic or sentinel or 100% bonus or a fund based, you need to know what's the worst come scenario if the policy doesn't perform the way it's supposed to perform. Because illustrations, what you see, a lot of people bring you so many illustrations. I can guarantee none of it's going to work. I can guarantee none of these going to work, because these are all our projections. So even on the projection side, what you need to look at the worst come scenario is what's my worst come scenario look like and what's my beautiful scenario look like. So you only see beautiful scenarios because you think jumbo policies up to age 100. No, not all the policies are jumbo policies are age 100. There are different policy structures, as I said, different engines into it. So if you don't know the engine, your policy is not up to age 100 or 90 or plus, So you need to know the guaranteed minimum age of the policy. Again, second thing which you need to know is the mechanism of the policy, or engine of your policy. Is your engine, that means your cash is going where? Is it going towards index? Is it just going into the long-term bonds? Or is it going towards the bonus which is guaranteed? Or it is going towards the long-term funds and things like that. So basis of different mechanism, different engines, your policy will perform differently. So you must know the mechanisms, engines. Projection, as I mentioned, look at the projections rate. What is the projection rate have been given to you? It could be 5.8, 5.2 or 3.1, 4.2. What is the projection rate? The more higher the projection rate is, the lower your premium going to be. Listen to it carefully. So higher the projection rate it is, the lower premium going to be. And the lower projection rate, your premium going to be higher. But that correlate with the engines of the policy. All right. So that correlate with the policy's engine, that you need to definitely have only expert advisor to tell you how these engines are impacting your policy. Before you get into these policies, please make sure that you are getting into the right policies, right bank, right advisor, who understand inside out about this thing, who can also safeguard you if your policy go into the risk in few years. Because giving you a policy, anybody can probably start giving you these days. As I told you, now many people are literally into it these days in UAE. But understanding is something which you need to know as a consumer. You need to know more than somebody just propose you on a table that what is that you are getting into that. Do you need a guarantee? You pay the price for that. You can take some risk, an index kind of plan. You can enjoy that. What age is good for which engine? I can share next time. If you have any questions, please do throw me these questions. I'll be happy to help you out in that. And as these are long-term contract, don't fall in for lower premiums. Don't simply fall in for because your friend's doing that. Hope this information is useful to you. Thank you so much. Do follow my YouTube channel on all this important information before you take a call on premium finance or jumbo policy or any other life insurance related questions you may have it. Please do drop me questions and keep watching me. Do not forget to subscribe to my channel. Thank you.